If you master supply and demand, your perspective on reading charts will change forever. With this, you won't just make profits, but you can earn huge profits as well. In this video, we are going to explain all these things to you. If you truly want to master supply and demand, I have one request for you. Do not skip any part of the video. Throughout this video, we will explain what supply and demand actually are. Why should you trade using this? How can you draw supply and demand zones on charts? And finally, how can you trade using them? How to enter and how to exit trades. At the end of the video, I will share my own method of trading supply and demand with you so you can understand what my strategy is. So let's start the video, where first we'll learn the basics of supply and demand. What is supply and demand? Basically, supply and demand are aggressive selling and aggressive buying. That's all there is to it. Aggressive buying and aggressive selling tell us where the big players or big boys are entering and exiting the market, and in which direction the big boys are pushing the price. Look closely at the candlestick pattern. These large red candles indicate that there has been aggressive selling here. This means that high volume and strong momentum are involved in driving the market down here. Now, pay attention to the next chart. Here you can see that there has been aggressive buying, which means the big players are pushing the price up with high volume and strong momentum. These are the two things you should look for when you are trading supply and demand, because such momentum tells us where smart money is entering the market, in which direction they are taking the market, and where they are exiting from the market. And if you see small candlesticks, you should not consider them as supply and demand areas. All these small candles are like the cute little babies of the market, and such candles neither have much volume nor momentum. Why should you trade supply and demand? First, I want to tell you why I trade supply and demand. We want to trade alongside those who have a lot of money, whom we call smart money in stock market terms. And I also want to make profits by following the big boys, the smart money. The best way to identify when smart money is entering or exiting the market is by recognizing supply and demand zones on the charts. When the market price moves downward, forming large red candles, we call that a supply zone. And the level from which the price rises upward, forming large green candles, is called a demand zone. We will only look at high momentum candles on the chart, which indicate that the big boys or smart money have entered the market. Always remember that we are retail traders, and compared to the big players in the market, we have much less capital. These big players have huge amounts of money, like 500 crores, 1,000 crores, or even 2,000 crores. Look at the charts carefully. After seeing such momentum, you can tell that the big players, whom we call smart money, are entering the market at this level. So my question to you is, would you want to buy at such a point? If your answer is no, then you will always remain a loser in the market. But I know that all of your answers will be yes, because you have come to the market to make a profit, and here it's like free money is lying right in front of you. You know that smart money has big capital, great power, and the ability to move the market. The biggest mistake retail traders can make is to trade against such smart money, which has unlimited time compared to you. Now you know why you should trade supply and demand. Now we will learn how to draw supply and demand zones on charts. The first method is that you should only enter a trade when you see at least 3 momentum candles. There might be 4 or 5 big candles in one momentum, but there should be at least 3. Only then can we enter the trade. For example, look at these 3 momentum candles. Keep in mind that you should not consider such small candles as supply and demand. In this example, we will use these 3 green momentum candles. The second thing you need to do is find the area where the momentum started, and then draw a rectangle box on the candle just before those 3 momentum candles. Make sure that the box completely covers the high and low of the candle. Now the rectangular area you see on the charts is a complete demand zone, and the next time the price comes into this zone, you should enter a buy trade from here. Because this has already happened here, the important thing to note is that the price came into this zone and then shot up, forming large green candles. Just imagine, if you enter a trade in the market at such a spot, you're going to make a lot of money. Now, let's look at another example. Pay attention to these 3 large red candles. Here, we need to select these candles and, touching the high and low of the previous candle of these 3 candles, draw a rectangle towards the right side. This rectangle area is a strong supply zone. That's why we need to wait for the price to come back into this supply area, and as soon as the price approaches the supply zone, I want you to watch carefully what happens. After the price enters this zone, it consolidates a bit and then moves down, forming a strong red candle. Here, the price literally collapses after coming near this supply zone. From this, you learn how to identify supply and demand zones on charts. Now let's learn another method, which we call the consolidation method. Take a look at this chart. Here, the price is moving up and down within a tight range, which we call the consolidation zone. Now we'll take a rectangle tool and draw a rectangle to the right side, covering this entire consolidation zone. Watch carefully what the price does after this. After breaking out of this consolidation zone, the price moves up for a retest, and as soon as it touches the rectangle box, the price starts moving down from there. The third method is to look for areas where the maximum number of candles have long wicks. The formation of wicks on the charts tells us that the price is being rejected from that level, and such a level is called a rejection level in the market. Wherever there are multiple candles with long wicks, what you'll do is select the rectangle tool and, covering all those candles with wicks, drag the rectangle box towards the right side. You'll notice that the next time the price reached this level, it shot up from here, forming large green candles. We can say that this is a very strong demand zone. Now we can confidently say that you have learned how to identify supply and demand zones on charts. After this, it is extremely important for you to know how you will trade it. In this chart, we have identified 3 large green momentum candles. Now, by covering their highs and lows, we will draw a rectangular zone to the right side, and your demand zone will be ready. Now we will wait for the price to come back into this demand zone. There are 2 most commonly used methods for entering a trade. The first method is that you can place a buy limit order so that whenever the price enters this demand zone, you automatically enter the buy trade. The second method is that you can place a manual buy order when the price reaches this level. We mostly prefer the second method because you should remember that no matter how strong the demand zone is, there is always a chance that the price could break that level. Now we are waiting for the price to come back near this demand zone. As soon as the price comes near this demand zone or touches it, you should not enter the market immediately. First, let the market give confirmation that it is now going to move upwards. You can see that a doji candlestick pattern has formed here, and these long wicks indicate that the price is facing rejection at this level. But we are still not confirmed that the price is definitely going to move upwards. That's why we will have to wait a bit longer. Just after that, a large bullish candle forms, and here we get confirmation that the market is now going to move upwards from this point. Because this bullish engulfing candle tells us that smart money is taking buying positions in the market. And you know that after the entry of smart money, the price is going to rise at a super fast speed. Here, we will enter the market with our stop loss placed below the swing low. If you want to be extra safe, you can place your stop loss just below this demand zone. If we talk about the target, look at some of the previous candles at the upper level. Here, there are 3 consecutive red candles, and just before them, there is a long wick rejection candle. This confirms for us that this level is a supply zone. That's why, when the price touches this level, we will book our profit here. When a supply or demand zone no longer respects the price, you need to delete the previously drawn rectangle and then draw new supply and demand zones on the charts. If we don't see any new supply or demand zone, we will wait in the market. When the price forms 3 big green candles from this level, we know that this is a new demand zone. We will draw a rectangle box to the right side, covering the candle just before these 3 green candles. Now we will wait for the price to come near this demand zone so that we can enter the trade. In this area, we can see that the candles have large wicks, so we can draw a supply zone here. When the price comes near this demand zone, it forms a strong red candle and slightly breaks this level. In such situations, retail traders often see this as a breakdown and enter into a sell position. But the next candle forms a bullish candle, which confirms that the price is now going to move up from here. In this situation, we will enter a buy position and set our target at the next supply zone. Our stop loss will be placed below the last swing low. After this, the price moves upward, forming bullish candles, and our target gets hit. If you are still watching my video, now I am going to share my secret trading strategy with you, in which I will explain how I personally trade using supply and demand. While trading, I don't just focus on a single confirmation, but rather look for multiple confirmations. Only then do I enter a trade. For external confirmation, I often use the Fibonacci retracement tool, and I only do this when the price is in an upward or downward trend. The Fibonacci tool should never be used in a sideways market, and since there is an uptrend here, we will draw the Fibonacci tool. In the Fibonacci tool, the 0.5 and 0.61 levels are the best for trading retracements. So, when the price comes between these two levels and a bullish candle forms, we get confirmation that the price is now likely to go up from here. After multiple confirmations, we enter a buy position, which is why my trades have a higher win rate than the average trade.